All right, so welcome everybody, Income Navigator members, new members, welcome, existing members, welcome, old members, welcome, and I don't mean age-wise, but everybody welcome. It is July 5th, 2024, day after the 4th. Everybody's back in action, and again, the markets are up 15 points today at 552 on SPX, so breaking the 550 mark. And most everything we have is doing pretty doggone well. And we're having another nice up day, another new all-time high. So good stuff here. Uh, all good. All right, so let's jump in. There's some questions in the Discord, some questions here, some things I wanted to make sure we covered today. Igor, anything you want to jump in on before we get started? Any questions or anything you want to cover?
I was just looking around to see if there were questions. I don't really see anything that we haven't talked about. Last was this 2 days ago,
Yeah, a couple days
but
ago.
I mean, if there are questions that I might have missed, please, put them up and we'll try to get to them.
Question from Paul. Interesting question on the 112s. Here, is there a diminishing returns on this? Meaning, what about going even longer on DTE and wider on PDS and then rolling those PDSs up and uh, letting the trap sit? Is there diminishing returns? I don't know. This might be something to take a look at one at some point, potentially. How far out do you go on these? The farther out you go, the more trades you're going to have on, the more buying power you're going to totally use up if you make this a campaign style trade. So I think you have to pay attention to what is your plan. For me, these are discretionary trades. I'm not campaign trading them right now. I don't have every 2 weeks. I have been pretty regular about putting these on at 150 DTE. There are some people out there um, that are doing 180 DTE. I know there's a Facebook group out there. I think Murray is on there doing like 180 DTE, which is all good. He's having good success with that. Uh, I think you can come up with anything that you want. As far as me telling you that there's a diminishing return or not, I really don't know because it's not something I'm actively studying. But obviously, the farther out you go, like our 120-day trades or like leaps or any of those trades, the farther out you go, the more buying power efficient things become. However, the more volatility there is out there, which is helping you with premium and it's helping you create some wide potential traps and things like that. So I know there's some people doing, I think, 180-day versions of these where they're rolling both the naked puts up at some point in time, they're shrinking the trap at some point in time. It's all good. I mean, I think you just got to really find what works for you. Just understand that the farther out you go, the more trades you may have on, the more buying power you may be using. And if your buying power becomes very efficient, you're also going to be putting on higher numbers. And when you put on higher numbers of naked puts, you've got a lot more risk involved. I don't care if you're at 5 delta or 7 delta or 6 delta, or you roll them up eventually. The more numbers of puts you have on, especially in ES and futures, the more risk you're going to take on. So I think it's really got to come down to, I mean, do I want these numbers? It's great when you have great buying power efficiency, but with great efficiency of buying power and great leverage comes great responsibility, and you really got to be smart with what you're doing. We're already, in my opinion, pushing the envelope a tad on risk and reward in and using ES and putting all these different trades on, which is why you typically will see that. And there was a question in Discord, so I'll get to a couple of these things today. But there was a question in Discord about leaps and using ES and using 120-day. Well, the reason that I don't do leaps in ES is because that strategy is a weekly strategy. So selling leaps every single Monday, and I'll ladder up to maybe 10 of those. Okay. Now, I built that strategy based on SPY and SPX. You can use it on ES, MES, what have you. You can use it on XSP. I know there are plenty of people doing some of these trades. However, I have found that with XSP and SPY in a PM account, it's a great efficient trade. In a Reg T type of account where you're also putting on long-term 112s and using ES, if you would do that in ES, man, that's just too many naked puts for me. It's just creating a ton of risk in your portfolio that you may not be able to hedge yourself properly for the notional value that you are taking on. So again, numbers matter. The more naked puts, the more notional value, the more risk you're going to have in that portfolio. So I'm not, the 120 day is I just put one trade on, and when it comes off, I put another one on, and that's only in ES. I do it in some other underlyings, but it's not really a campaign version. It's, hey, if it sets up well, let's go ahead and put it on. Okay. In oil right now, we're starting to get over, maybe I'm moving on to too many things. In oil right now, we're starting to get a bit overbought on the daily. We're still in pretty good shape on the weekly. I think oil can move more. There's some, tensions heating up a little bit in the Middle East. There's hurricane season starting to get underway. We're early, but I mean, Barrel's a pretty strong first hurricane out of the gate for the year. If that portends a significant hurricane season, then you start to run into risks of, you know, shutting down rigs in the Gulf and other, interruptions to oil, which starts to, impact oil pricing. I don't think it's making a huge dent in oil pricing, but it can. You're also in the middle of summer driving season. But these things should start to, that should start to fade. But the hurricane season coming up and tensions in the Middle East and what's going on with Saudi Arabia and all of these different things. So I think all these things factor into it. We just trade what we see. I don't really care about all that news. The key is, what am I seeing? And right now I'm seeing oil running from 73 to 84 in 4 weeks without taking a break. That's pretty overextended. So for me to put on another 120 day here, even though we just had one come off, probably not the most responsible trading thing to do. Even though the weekly chart says, I think we could still do pretty well, and we could still put it on. I'd love to see a little bit of a pullback to the 21 or something like that. Anyway, I hope that makes um, I hope that makes sense uh, with what you're trading. So again, if you want to go to 150 or 180, or you want to go to 365-day 112 trades and make gigantic traps and add more, it's all good. It just, again, the farther you go out, the more trades you're going to have on. The more trades, the more naked puts, and the more benefits to buying power, the more typically you probably are going to be tempted to size up. So, Igor, any comments on that?
Yeah, I think you pretty much nailed it. There is no right and wrong, right? I think there's only what works for you and what doesn't. I would probably um, try doing different duration trades as far as 112s go, just to see which are better suited for you as far as buying power goes, as far as sensitivity to price fluctuation on a day-to-day basis. But off the top of my head, I can tell you that I guess the way I think about these trades is right. There are two columns. There's the plus and there's the minus. Everything has the good and the bad. So the good with 180 plus DTE is that your initial buying power is going to be much lower, which is great, which will potentially allow you to leverage your account further and put on more trades. The negative is that, if you spend your capital because it only takes so little to put trades on, you may be over extending yourself, right? You're giving yourself almost no room for error. So you got to think about that. Another positive is that if you go 180 plus DTE on a 112 and you take out your short naked puts at like, you know, 85 or 90% of max potential profit, you are left with a put debit spread that will probably have, maybe like 90 days to go, which means that you will have a free put debit spread, right, that you paid nothing for, and that's going to hedge your positions that you're putting on, in a campaign style. So there's a lot of good and there's a lot of potentially bad. You need to kind of weigh both and figure out, what works best for you.
Yeah, and the one question here, what is a campaign trade? So if you're newer to the service, I mean, we have a variety of different trades. Sometimes they're campaign style, sometimes they're what we call discretionary or opportunity trades or opportunistic trades. A campaign trade is when you're putting something on based upon a certain criteria repeatedly, mechanically. You're not even taking into account, the charts or anything else that's happening. You're just putting something on a regular basis, either like the 120-day long-term 112s. We put them on every 120 days. Some people put them on every 2 weeks. But in other trades, we may put on where we put a trade on, and as soon as it closes, we put another one on immediately. Or on the leap style trade, we put them on every single Monday, no matter what the market's doing, we put them on. Those are campaign style trades. They're based upon entering on a time basis, or an event, or maybe something closes. Discretionary trades would be trades that you just put on when the setup is right, when you have the buying power, when you need certain delta, when you need to get certain style trades on according to your trading plan. You can add discretionary trades. For me, there's only really two campaign style trades that I work, and that's the long-term 112 trade, and it's the 120-day naked puts on ES. That's it. Those are the only two campaign style trades. Everything else is discretionary. I put them on when the setup seems to be correct. So I hope that makes sense. It's hopefully pretty easy. All right, let's see if there's anything else. I know there's a hedge question because what would a Zoom session be without talking hedging? So Jeff, because it's you, Jeff, and I like you, I'm gonna answer the question, but otherwise, no shortage of hedging discussions in the channel. So let's get it out of the way so we can focus on more positive things down the road. So let me pull up my accounts here today. So I'm going to share, and I'm going to jump in, and I'm going to throw a hedge on. Well, I'm not going to throw the hedge on, but I'm going to show you what I would do here, and I'm going to give you a sense. We'll let some people in. I'll make sure everybody's muted. Igor might accidentally mute you, but all right. And let me, before I share, clean up a little bit what I got.
I just want to
Okay, go
add
ahead.
one thing real quick about the different DTEs, right? So I did a number of trades in XSP and SPX. These trades were like 55 or 52 DTE, and I would take off the naked short puts at about 90% of max profit, and that would leave me with a put debit spread that was fully paid for. So it was kind of like a free downside hedge, which was maybe 3-4% out of the money, but it only had 18 days left until expiration. So very unlikely to get hit, but if it does, it's definitely going to help out. So I started doing ES 112s at 90 DTE, and I take off the naked short puts at 90%, 85% sometimes. And that leaves me with the put debit spread for free with almost 40 days to go. So, right, you start trade with a little bit longer duration, and then eventually, when you take off the naked puts, you're left with a put debit spread that has 40 days. Now, that's more of a hedge. Like, I like to hold it for 40 days rather than 18 days, right? Because chances of the market going down 5% over 40 days are greater than market going down 5% over 18 days. So you get a longer hedge if you start 112 with more days until expiration. But as far as, how far to go, it's 180 too far out in time. I don't think it is. It's just going to be a lot slower, right? You have to think about that.
And I will come back to the question on Vega because I want to let Igor answer the question on Vega because I know he's talked about Vega and the way we trade with Delta and so forth before. So I'm going to let him answer that or think about that, about adding additional Vega or adding all the Vega and going out further with Vega. It's not really a big thing for me, but we'll talk about it from a technical standpoint. It's not something that I really focus on a whole lot. All right, so let me share. And what I want to do is I will start in the trade tracker here. And then the question from Jeff in the Discord and is, you know, again, there's 900 ways to hedge. You just find one that works for you and do it and sleep at night. That's really the key for me. Okay. If you can't sleep at night, you don't have enough hedges on or you got too much risk. If you can sleep fine at night, you're probably okay. But it's all personal. It's all a matter of, what do you want to do? Do you want to buy insurance? How much life insurance? You can't ask me how much life insurance, Tom, should I have? I don't know. I don't know what you're covering. So I really don't have any idea what you want to cover and what you feel you need for your family. It's a personal decision as to how much life insurance you buy. Maybe you don't need any life insurance. Maybe you only want 30,000. Do you still have a mortgage? Do you have all kinds of stuff? Do you have kids? Have your kids not gone to college yet? Have your kids graduated from college? Are you 87 years old? Are you 47 years old? Are you 7 years old? And if you're 7 years old, do you need life insurance? If you're 87, do you need life insurance? I don't know. Right? Depends what you're trying to cover. Same thing with hedging. It's what you want to cover and what's going to make you most comfortable when it comes to that. All right. So one thing for me is just from an easy snapshot, I will take a look. And the reason I'm showing my trade tracker here is it's really easy for me to get a sense of assume that all of my ES naked puts take a 2x loss. Okay. So I've got one here. Okay. 2, 3, 4, 5. So there's 5 here. They're roughly 5 grand each. Okay. So there's 5,000, or there's 5 times 5 grand. There's 25 grand there. Okay. And there is a strangle in ES here. So let's say that, let's say we're at 30 grand. And then up here, there's a few of these 40, 35, 40, maybe $45,000 worth of ES. Okay. I'm not even, not looking at the fact that I have other trades on. Okay. So I have $45,000 worth of naked puts. Essentially, it's a rough estimate, $45,000 in naked puts. If they all went to a 2x loss, I would lose $90,000. So the question was, well, how do you hedge that? Again, this is me, not you. Okay, what would I hedge? How do you hedge $90,000 worth? So really quickly, let's see here. Let me share. Let's go to an account. All right, so here's our account. We're gonna go trade, and I'm gonna pick up a trade, and I usually like to go 60 days. I will overlap some of these, which means I'll have 2 of these on. If I have 2 hedges and I have to hedge 90,000, how much do I have to hedge per trade? Shouldn't be a trick question, but it should be around $45,000 per hedge. If I have 2 hedges on, you could buy just 1 hedge and do it. But if, let's say I have 2 hedges on at a time, and I put it on every 30 days, and I go out 60 days, which means there's always 2 running. 1 falls off, 1 comes on, 2 running, and I'm hedging 90 grand. Okay, that's just me. I don't know about you. I don't know what you got to hedge. Okay, now if you want to hedge your whole portfolio or not, I'm not really worried about my oil, my gold, and my bonds. Okay, I'm worried about ES. Right, so I'm going to find something. I typically like the 60-day, but you can do anything. You can do 30-day, you can do 14-day, you can do whatever you want to, but you got to make sure that you are covering what you want to have covered. And I'm going to just slide on down because I don't like. So I've talked about this before. I prefer multiple contracts to hedge that are typically farther out of the money. Why? Because if the market starts to sell off, okay, number one, the more contracts I have, the more positively they're going to react to volatility, which means the more bang for my buck I'm going to get. Now, I could buy an at the money put, okay, here. And if we took a look at it, okay, if I bought an at the money put, come on, okay, then if we sell off, that at the money put is going to give me a nice, X amount return. Uh, let's say for for argument's sake, because this is all argument's sake, none of this is uh, set in stone because all kinds of factors come into it. But let's say we need to hedge roughly a 10% to 12, let's say 12% because it's easy to deal with. Let's say a 12% sell-off. The other thing to consider, and again, I'm not considering this when hedging, is how fast is that sell-off? Does that sell-off happen in a week? Does that sell-off happen in 30 days? Do we go down 3% a week for 4 weeks? Okay. If we do, most likely we will get stopped out on some, but not others. The older ones aren't going to be affected. The older naked puts that have like 30 days left in them or 45 days left, they're not going to be affected by a 3% a week sell-off for 4 weeks. They're not going to do much. The only ones that are going to get stopped are going to be newer ones. So, but I'm going to take into account that they'll all get stopped out on a 12% drop. We're at 5,600. Okay, and a 12% drop takes us to about 49.20 or so. Okay, so if we bought them at the money, and we go down to about 49.20 or so. I don't know why these numbers at the top and bottom never match up, but let's say we go to 49.20. I'm using the price on the info piece here. Okay, this will pay off around $30,000. Okay, and it's costing me $5,000 to do that. Well, $5,000 is more than I typically want to spend, so I gotta go out of the time and money. I don't want to spend $5,000. I want to spend closer to 2,500. Otherwise, I'm just going to eat all my profits, and it makes no sense to hedge. Right. So if we take a look at this one, okay, we go down to 4,900. Okay, now it's only going to protect me for about 2,500 or $25,000 in sell off. Okay, even if September 6th. Okay, even if volatility goes up 20%, okay, and we go down to 4,900, okay, it's still only helping me to the tune of like 27,000 now. So even with volatility, this is not helping, right? So now what do I want to do? Let's look at quantity of two, okay, but I only want to spend 2,500, so we're going to go down further. All right, so let's do something like this. So now we're at the 5070 or 5270 put, which is somewhere around 14 delta. Now I'm doing two contracts for 2,500. How is this going to react at 4,900? Okay, well, now you can see for the same 2,500, okay, if volatility does its thing and goes up 20%, down around 4,900, now this is starting to pay off close to about 45 to 47,000. Okay. So now I'm at 47,000, same amount of money. Okay. But because I have more contracts, they're going to be more beneficial when volatility rises. Okay. Well, if that's the case, okay, what if I go to 4 contracts and I go down even further? And now I'm going to do something around, I'm going to use 5,000 because this is kind of where I like it. Anyway. So we're going to go down to about 5,000. That 5,000 is going to sit around a 6 delta. Okay. But if we go drop to 4,900 on these, can't really see everything here. All right. We dropped about 4,900 on these. Okay. Now it's protecting somewhere around $65,000. So you can see that. Okay. 17 is the expected, but with the theoretical here, the orange line, because of the increase in volatility going up, these are now protecting 65,000. Okay, does that help, Matt? Right, so there's nothing else I can do. You close it on yours. But hopefully you can see. Maybe Igor has to jump off video or something, but
I took
I'm
the
off.
video off.
Yeah, I'm off
Yep.
video on mine.
Let me add something to this discussion about hedging. This question comes up all of the time. Question is, so when do you close this long hedge if the market continues to rise?
Yeah.
And, this might sound corny or, silly. But the way I look at it is, if you buy car insurance, right, it's a 6-month policy and you're paying maybe $1,500 premium that covers you, right? You go for about 4 weeks without a car accident or a car being stolen. You wake up one day and you say, well, it's been 4 weeks, right? It's been a month. I have 5 months left on my policy. I haven't crashed. Car hasn't been stolen. Do I just cancel the policy? I think the answer is no, right? So when you buy a hedge, it's almost like you have to take this money, you put this on, and you say goodbye to this money, right? The only way you're going to see this money if something terrible happens to your portfolio, right? So I don't think that buying hedges and then selling them and then trying to buy more hedges, because market goes up one day and market goes down one day, you're going to end up cutting yourself up into a million pieces. I just think that you decide how much hedge you need, you put it on, you wait for the term, if those hedges expire worthless, you do the next tranche of your hedging and you just keep, your one side of your portfolio is going to generate the income, and then you're going to commit spending some of that income to protecting your portfolio for the, worst case scenario. But I don't think that trading around your hedges, taking them off because market continues to rise, and then one day in the market goes down 2% and you don't have the hedge, now what? Right. So I don't think that there's a right and wrong. Personally, I don't like the idea of putting on hedges and then just because the market hasn't gone down, um, you know,
Hmm.
closing out these hedges and then waiting for when things get worse to put these hedges back on. Look, if you're just going to trade directionally, then trade directionally. But hedges are, in my opinion, hedges are meant to be put on and just let them do what they're going to do. And the 99% of the time, they're probably going to expire worthless anyways.
Exactly. And I want to put one more thing out here for everybody. So we went all the way down on this particular trade to about 5 delta here. So I'm doing a 5 delta just for, I went to 5 position. Let's go back to 4 and let's go back up to, because I'm going to tell you I'm going to spend like $2,200 on this. All right. So we're sitting here, and I did plug in the fact that I'm using per contract IVs, and I jacked it up 20% here. Okay, so we're looking at a 20% bump in volatility. And again, 4,900 or so is, I believe, 12% drop in the market. Okay. And this particular hedge at 4,900, is around $65,000. Okay. That's what it's going to pay. Okay. Remember, I was trying to hedge 90 and I have 2 of these on. Okay. So I should be pretty set, okay, on average. Okay. But let me talk for 2 seconds about other types of hedges that people may be doing. Now, is there diminishing returns? Yes. So let's say, well, Tom, if that's the case, well, why don't we just go down even further, okay, to these ridiculously low levels here at like 3 or 2 delta, okay, somewhere, let's just pick a $5 one, okay. All right, well, now you got to increase your quantity back up, okay, and I'm going to look back to 4,900 or so, right? So you could continue to go down, but as long as you're increasing your quantity, okay, you're fine. Take a look, this thing is now going to pay off almost 90,000 if we go down, but you got to get a volatility pop. If the volatility doesn't rise, this hedge isn't going to pay that kind of money. So again, the further down you go, the better off you are, but only if you have lots of contracts. If you're still sitting at the same number of contracts down here, that hedge is not anywhere near as valuable. So you have to have lots of puts at lower deltas, okay? And that's essentially it. So it's enough on hedging for today, but my goal is find the strikes and the quantity. I go 60 days, but you can go 30, you can go 15, you can go 27 and a half and 3/4 days out. I don't really care where you go. You can go to anything you want, okay? But find a strike and a quantity that's going to pay X amount of dollars to cover my losses, okay? So that's how I'm doing it. That gives you a sense. I do not take those hedges off. They are losses, okay? And the only difference again between mine and the Black Swan hedge type thing is that they're deliberately selling options to pay for their longs. I'm just using the money I'm already making on other things to pay for my longs. Okay, it's the same principle. They just allocate specific trades to pay for their longs, and I'm just taking money and paying for mine. It's the same thing. Either way, you pay. And either way, you're selling something so that you can buy something else later. All right. So hope that makes sense for you and gives you a little sense of what that looks like here. We did have, and I'm going to keep going. So we did have also uh, not in this account, but in a couple of the other accounts, I did have some bond trades. I did have some bond trades come off. So I'm going to actually add one here because I am sitting on a strangle here. This particular strangle, ooh, starting to close. So this strangle's at 46%, but you can see I just actually got filled on one contract of that already today. So this strangle's at 46%, and this strangle is at 38%. So they're getting there. I hate to go too crazy, but this is 28 days out, and I could be looking at a new strangle here. So that was this strangle that I put on earlier today has not been filled. So I'm really not ultra worried about it anyway, but it's down here. It's around 7 delta on the shorts. It's around 6 delta on the longs. It's at 25 ticks or 25, 30 seconds on it. But or 64, I should say. But it again it hasn't been filled. Can I go down to 24? I probably could. Okay. And I will probably get filled on this. Either way, it's still not a big deal. I mean, instead of 1 tick times 10 contracts, I'm going to make $150 less, which again doesn't really matter uh, to me on it. But if I want filled, we can put it on and I'll get filled. All right, so that one was filled in here. Now we have a new strangle. We'll group it. This was a September 20 strangle at 77 DTE. Boom, it's working. And then also I will automatically go in and put my closing order on there as well. All right, so we got a closing order working. Nice thing about the closing orders is, hey, I did close 1 out of 7 contracts of this strangle closed earlier today. So not bad. Starting to make some money actually on closing this strangle out. So we're close to this thing closing itself anyway, and we had the buying power to do it. So it's all good. 76 is not my actual buying power because I'm sitting on an SPX trade that's chewing up a bunch of buying power right now. All right, so we're sitting on an iron condor here that's up $320 today from a 0 DTE trade in this account, and we haven't closed it yet, but we're close. So when that'll free back up most of my cash. All right, so there's that trade. Let's get back at it. So hopefully that helps on some of the hedging. Again, for the umpteenth time, so you guys get a sense of how I'm hedging. Everybody's not like that. So you hedge, again, what you want to hedge and what makes the most sense for you. How much insurance do you want? And like Igor said, why would you put insurance on one day when you feel sick and then take it off the next day when you feel healthy? I mean, that makes no sense. You just put them on, leave them on, and you just take your lumps on the losses on your hedges. Okay? That's what they're there for. They're a losing trade. Hedges lose money. And just bake it into your trades, and you're fine. How many ES long-term 112 trades was I stopped out on in the last 4 years? It would be 0. It's never happened. Okay? So never happened on long-term 112 trades. In fact, it's never happened on any real 112 trades in ES. The only time I was stopped was I did take a stop off on a 111 trade back in 2020. Anyway, there you go. That's what we got in here. Other questions before I jump in. So I give you a trade there on bonds. So I added a new trade on bonds. Also, so we have this trade on in Palantir. Now, one of the strategies that I use is a little longer term credit spread. Okay, so one of the strategies I like is a longer term credit spread. Why? Because I potentially, it's a version of the wheel. Okay. Don't love the way the wheel is actually constructed, doing the basic wheel of, hey, sell a put, hope to get assigned, sell calls to try to get out of it or make some money. I never want assignment. Okay. And well, pick a stock that you like so that if you get assigned, you're happy with it. I'm never assigned and been unhappy. Okay? If I'm assigned, I have a loser. Okay. I don't like losers. Okay. So I don't like any stock I'm assigned on because that means it's a loser. So how do we do better? Well, for me, I will trade stocks that look like they have a decent weekly trend going. So Palantir is one of those. I think we got this one timed like 100% perfectly, but it's all good. It's better to be lucky than good sometimes, right? But I like to start with a credit spread, and I'm going to start with something around 75 DTE. Okay. I will give all the credit in the world to Bill Goodwin for the idea behind this trade to a large extent, and then kind of my version of it. But I like 75 DTE. If I'm assigned Palantir, I would get assigned at the 18 strike here, which we're now sitting at 27. Okay. So I'm fine, and I don't want to get assigned. Okay. But if I did, that'd be fine. But I also like to start this trade as a spread. Why? Because if the stock tanks, yes, I'll get assigned at 18, but these 15s potentially could be worth some money. Okay. So I will get paid additional. Okay. I'll get assigned and I'll still make money on these longs. Okay. The same thing's going to happen if I get assigned and I'm going to write calls, I'm going to write a call spread, which means if it blows through my short call, my longs will start to pay me some cash. Okay, so I'm going to get the stock called away. Okay, the thing I hate about the wheel, two things. Number one, you get assigned crappy stocks that are falling. Okay, I don't care if you like it or not, no one wants to get assigned. Okay, but you're assigned a crappy stock, which means you're losing money. Oh, you got paid to lose. I don't want to get paid to be a loser. Okay, I want to get paid to be a winner. Okay, so I want to have stocks that go up and not get assigned. However, okay, if you get assigned and the stock keeps falling, okay, now you're going to have a bigger loser, even though, oh, but Tom, you're reducing your cost basis. Yeah. So the goal is to break even. Is that what you're telling me on the wheel? That's why I hate it. The other part that I don't like is that if you sell a covered call, you cap your winners, which means I could have made more money. Right. So the spreads gives me a way to get around that. Now, the one thing I will do here is instead of letting this thing expire, I'm up 82% in 30 days. There's really no reason for me to hang around in this particular trade. Okay, so I think getting out of this trade, if I can, today makes sense. So around 70 to 80%, I'll bail out of these. I have one on AMD. It's at 55% right now, which is not at my target. So I'm not going to do anything. We have 42 days left in the trade. I'm not going to do anything on either one of those trades today. I have not I have not closed out SPX, even though I'm trying to close it at 40 and it's at 33. I don't know. All right, so hopefully that helps. It gives you a couple different. What's my target on AMD? What do you mean my target, Lewis? My target's just to make money. So I'm not sure what you're saying. My profit target on AMD here is, well, if this thing expires. Okay, that was my target on this thing was I sold this for 356 bucks and I used 1600, so I'm going to make, I'm hoping it just expires. Okay, that's all. My target is the plan, if you read the trade plan, is let this thing expire. But if you want to, you can close out at 70 to 80% profit target. Either way, there'll be pretty significant winners. There'll be over 20% winner on AMD and probably a 15% winner on Palantir in 30 days. So either way, they're really good trades. Okay. If you're looking for what delta, it's in my trade plan, so you can check that out. Typically, I'm around 12-ish delta or so. Okay. Totally different trade plan. These are 75 days out. Totally different trade plan here. I would suggest that you check it out or check out the Palantir trade. I'm pretty sure I outlined it there, but it is, or check out the video that I did on how I sell, um, the credit spread strangles. So it's the covered strangles essentially trade. Okay. But I will typically sell like a 12 delta put and go, I don't know, whatever the width is, 10% lower on it. But just check the trade plan. It's in there on covered strangles. All right. I hope that makes sense. Hey, we're doing fine here. I'm still trying to figure out why I can't get filled on my 0 DTE, considering that it's trading below my uh, my profit target, but that's okay. All right. So there, that gives you that. Igor, I wanted to circle back with you on this. So let me stop sharing and we can get back on. If you're still there, Igor, I wanted to circle back on the concept of Vega, and is that something we need to really be paying attention to on these longer term trades?
As far as Vega goes, we have to assume that volatility is going to be a mean reverting instrument, right? Volatility doesn't rise forever and it doesn't fall forever. It can stay low for extended periods of time, such as, what we're seeing right now. And it's not a terrible idea to look for some kind of volatility hedges, especially if you are putting on longer term 112s or you're selling um, strangles that have 90 or 120 days until expiration. 3 months out, a lot can happen, and you are essentially exposed to volatility more than delta, right? Because these trades are with a lot of time until expiration are very forgiving at first, which means that they're not as sensitive to price changes, but they are more sensitive to volatility changes. And then as the time goes on, the volatility sensitivity starts to kind of unwind or starts to draw down, and your sensitivity to price changes starting to increase. So as far as Vega goes, yes, if you're holding a lot of positions that are short Vega, and you want something that will help you sleep better at night, I think that instead of trying to hedge um, your absolute Vega, if you're short 1,000 Vega right now, do you want to go put something on that's going to be positive or plus 1,000 Vega? I don't think it makes sense, and I'll tell you why. If you're thinking about buying volatility, what does that mean? This means that you are going to pay for this volatility. You're going to pay a premium. If your business model is to sell premium, and then you're going to spend some money to offset some of that volatility exposure, you want to pay as little as possible. So if you're going to offset all of the Vega that you're holding in your portfolio, essentially you have no business. You sold premium, you use that premium to buy premium, then what are you doing? Instead, my opinion is that you want to figure out how much Vega you want to offset and then go. You don't have to go. So if your positions are in 120 DTE, you know that options that are closer in time to expiration are going to be more sensitive to volatility changes, right? When the market dives, you will see implied volatility increase a lot more on the contracts that are closer to expiration. So that's where you want to be. And then you want to go as far out as you possibly can. I keep talking about buying units. those are like one or two delta puts that are 99.9% of the time are going to expire worthless. But if you are going to see the kind of move in the market that's going to hurt your position due to just volatility alone, we're talking about down moves in excess of 15, 20% in a very short period of time, you want to have those units. They're going to come alive really, really fast. And if not, most of the time they won't. And, odds are whatever you're paying for it, that premium is going to expire and you're going to lose money there. But the time when the market really dives and volatility really explodes, and we're not talking about VIX going from 13 to 18, we're talking about VIX going to 30 plus, those units are going to come alive. So I wouldn't focus too much on how to offset all of your short Vega. I would probably look to buy something that is 25 or 30% out of the money, say goodbye to that money, whatever you're paying for those puts, and just know that if volatility is going to explode, you will count on those um, units to kind of save you a little bit. Don't think that they're going to completely, mitigate all of the losses. There are going to be losses because you're going to lose not only due to volatility increase, but your delta is also going to be against you. If you're short premium on the way down, you're going to pack on a lot of positive delta, which is not going to be your friend at the time. So volatility, go far, far out, 20% plus. Try to pay as little as you possibly can. And don't worry too much about volatility because if you have a 120 or 150 days until expiration and volatility spikes in the next 30 to 45 days, yes, it's going to suck, right? Volatility is going to put pressure on your positions, but think about if we have to assume that volatility is going to mean revert at some point in the future. When things settle back in, right, that volatility pain is going to go away. So don't, try to offset all of your Vega right away. Have some, far out of the money protection for the time when volatility spikes, but focus on your delta more than your Vega. Essentially, over, 30 days, 6 days, we don't know. But at some point when volatility reverts, all that Vega will go away and you are going to end up with Delta as your main driver for your P&L in your positions. So I hope that makes sense. If it doesn't, please post follow-up questions, and I mean we can talk about Vega hedging um, for days. But I think that the main focus shouldn't be as much on Vega rather than Delta. Delta, I think, is a lot more important because remember, price could trend for long periods of time, kind of like what you're seeing S&P at all-time highs. If you put on position 3 months ago, well, guess what? The price didn't really it sure did revert back to the mean, right? There's an underlying moving average, whether it's 20-day, 50-day, or 8-day, whatever you may be using, price will eventually come back to test the moving average, but moving average will move higher over long periods of time. So Delta is not as mean reverting as Vega. I think that if you spend a little bit of money to kind of buy yourself that, oh shit, insurance policy, something that's, 25% plus out of the money on the downside, I think you'll be fine. And try to pay as little for it as possible. And don't expect, right, to see any of that money unless you see some sort of a move to the downside, which is not going to be pleasant to begin with.
Yep. So, really, really good stuff there. And there's a question, and maybe it's similar. So again, I don't really track the Vega that much. I understand it's going to be significant. I understand as a premium seller, if volatility pops, I'm going to have some pain. I'm really mostly concerned about, again, what do I have on in just ES? Am I diversified among the other portfolios? Am I hedged enough on that? Yes. Okay. I feel okay. Can it go significantly awry? Sure. Newer trades are going to get hammered harder. And there's a question here in the chat about making decisions based on being delta neutral and examples on how to beta weight and keep your account when you're first starting trading in this style. Um, and I'll take a quick crack at it and let Igor jump in with his 2 cents. Is don't overthink delta. Um, I I happen to be delta neutral because that's just the way I trade. Because I'm heavy on strangles. 112s, they start out as somewhat delta positive trades, and then as they age, they start to become more delta negative or delta neutral trades. We are getting filled on these ZB strangles, so that's all good. So anyhow, but don't get carried away on it. If you're going to start an account and you're going to start trading with 112 trades, you're going to be putting on delta positive trades. Okay? If you're going to be putting on naked puts, you're going to be making it more delta positive. If you're going to be putting on ratio spreads, you're going to be even more delta positive out there. However, the 112 trade is not the same as like a naked put. I mean, it does have other components to it. And as the naked puts start to decay and the put debit spread, whether it comes alive or not, it's going to start to become a more delta, neutral trade. And a good way to look at that is let's take a quick look at, I don't want to turn that camera on. We'll get back off so you can see, but let me go back and share the account here. If I'm going to look at, uh, here's the oldest 112 trade that has not had the naked puts come off. Okay, it's the August 30th one. All of these other ones up here are just put debit spread, a strangle that's losing, a 112 put debit spread, a hedge that's losing, a 112 that's just the PDS. Okay, but this one is still on. But if you look over here, delta wise, this is sitting at like a 20 delta. Okay, this is a 20 delta trade with 56 days to go. That's pretty doggone delta neutral. Okay, if you look at a most recent 112 trade, not the XLs, here, it's 120 delta. So hopefully, I don't know if you can see it here, but this is a 120 delta trade. So again, they start, even though this is already starting to win a little bit, it starts off at 120 delta. Then it starts to melt down, okay, to something like 80 delta, after 14 days. Then it starts to melt down to 56 delta after about 46 days. Okay. Then, as I showed you before, it starts to melt down to something around 20 delta, okay, after 66 days. And then by the 90th day or so here, we're out of by 90 days into the trade, we're out of the naked puts. So now this is a negative delta trade. Okay. And you've got negative delta, negative delta, negative delta. Okay, here. So these are all negative delta trades left over. There's only a couple of the long-term 112s. I only have 5 of them currently working. Okay, there's 3 of them that have come off because one came off a little earlier than expected. So we're still, a little more than 30 days out in this one. So this one still has some time. It's at 66 days. They usually naked puts come off around 90. So the thing to bear in mind here is you're going to be more delta positive early in the trade. These are going to start to go down. But then as I start to add strangles and other things in here, I mean, look at this strangle. Okay, yes, it's losing because the market's only going one flipping direction. Okay, so it's down. It happens. If I take a loss, take a loss. Okay, but look at the delta on this thing. It's minus 700 right now on that particular strangle. There's a hedge here that's dropping my delta down around 20. Not a big deal because it's far enough out of the money. It's not doing a whole lot of anything here. So don't get caught up and overthink your delta, and don't have to force yourself to be delta neutral. I love being delta neutral because I'm pretty market direction irrelevant. I really don't care which way the market goes. If the market stays flat, almost everything I do wins because I'm a premium seller. Hey, SPX finally filled. Okay, so we got a winner on that one. I don't know if it filled on the active trader, but yeah, looks like it may have also filled there. So, all right, good. So we've got winners here and in active trader on 0DTE. So anyway, Igor, you want to jump in at all? Any other thoughts on that? And we can jump back on video, but uh,
Yep. Going to just I think you did a great job explaining your thoughts about Delta, and I look at things same exact way. If you're running a business selling premium, you can't focus too much on Delta, right? To me, Delta is a byproduct of what I'm doing. Sometimes I'm going to be Delta positive because market's going down. Sometimes I'm going to be Delta negative when market is going up. I can react to my Delta unless I'm in a crunch or positions are close to getting stopped out, then I look at Delta and try to figure out how to neutralize things to kind of, put a pause on things if the market is moving too fast. But for the most part, Delta is like secondary to me. Well, I do look at Delta if, for example, if I'm putting on trades, like I want to be aware of what is my current net exposure to the market and do I want to add any more in the same direction, or maybe I want to go lightly in the opposite direction or neutral or whatnot. So, my delta doesn't tell me, that I need to do something. My schedule tells me that I need to do something. My delta might suggest what kind of new trades I want to put on. Um, and for the most part, I see questions about, the delta portfolio, or sorry, portfolio delta and portfolio theta, and how to keep those at some sort of targets. I don't think that's the right way to do it. Um, Maybe some do use it to put on their positions. I don't. I think delta is just a result of positions that you're putting on. As long as your plan, your strategy builder is telling you what kind of positions and what to put on. The delta is just going to kind of work out on its own. You're lucky if you're delta neutral at all times, but that's probably not the case if you're short a bunch of premium both on the upside and on the downside. I just want to briefly touch on one thing going back to hedging. Jose Garcia said, calendars or double calendars out of the money provide a positive vega and can work as a vega plus delta hedge. I think that we need to spend time on another video because we can go on for hours talking about calendars and why I think that calendars, double calendars, even though if you model the trade, it does show you positive vega. In reality, it doesn't work that way. In other words, if you put on a double calendar and the market pukes, there's a very good chance you may lose money, even though the trade is technically vega positive. But because you're short premium on the front end of the curve, which is usually going to spike hardest, and your long premium on the back end of the curve, it actually is going to work against you. I think what Tom described out of the money puts, what I said about buying units. In any case, you want to be long gamma and you want to be long pure gamma, not as a net result of selling an option, buying another option, looking for that Vega. If you're going to buy Vega, buy it straight up. Puts, try to pay as little as possible, go as far out as you can for it to make sense, and don't overcomplicate things.
and I think that's another really good point too, is don't overcomplicate things and don't make your life so hard that you have to make minute adjustments to everything. Okay, that's what the brokers want you to do. I'm not trying to say anything against Tasty Trade, but that's what they want you to do. They want you to keep making little adjustments and roll this and adjust that and add this trade and add it. Okay, you don't have to make life that complicated. Okay, make your life easy. Okay, set some parameters, watch your parameters, put your trades on, size them properly, adhere to your trade plan, and your life will be so much easier out there if you just stick to the basics of things and don't try to come up with 19 ways to make your life more complex. and hard up there because usually what happens is most of the time you end up wrecking yourself. So it's kind of the check yourself before you wreck yourself piece. Here is you usually end up outsmarting yourself, and then Gary, Gary Crosby he made the comment, and it's probably one of my favorite sayings is that volatility will mean revert, and price does not have to. Okay, so just because something's happening with volatility, okay, or you're worried about Vega or something, I don't put as much stock in that because it's going to mean revert at some point. Do I get stopped out? Yeah, you know, and you can get stopped out two ways. You can get stopped out with volatility spiking, or you can get stopped out with a price move, okay, or some combination of the two of them. Usually it's volatility that stops me out more than price move, but it's probably 50-50. Um, there. I might get stopped on an ES strangle. I don't know. Okay. Maybe because price isn't stopping going up. The market is unbelievably bullish and continues to move higher. It's overbought and it continues to rise overbought. We are in, a year and a time period where the markets are just unbelievably bullish. There may come a time where they're not. Okay, and that'll test us all. But don't overdo it. Just keep it simple and stick to your plan and don't try to adjust everything. It's my 2 cents. All right. Before we jump off, I want to make a couple just quick announcements in there. So yes, we did. I added some more bill to my account today because my account's up, so that's all good. We did close a ZB Strangle, so I just actually closed that in the Discord. So I closed a ZB Strangle, which is pretty cool. So that closed today with only at 48.5%, but we did get our 50% winner. So sometimes uh, nice to get on the right side of things closing. So adding that new ZB Strangle here is essentially just a replacement trade. So I've added a ZB Strangle. We closed a ZB Strangle for a winner now. And if you look, or if I look on my strangles, that now puts us at 36 winners out of 39 trades. So I will take that all day, every single day. 36 divided by 39 is 92.3%. So I will take a 92% win rate on strangles. You lose some, you lose some. If that ES1 goes, oh, well, okay, I guess I'm back to 90% win rate. So you win some, you lose some. And I think that's great. And then SPX, we did close out a 0 DTE today. For those of you that are newer, we are going to do a new member orientation on Monday. So I did post that already there. So I've got that queued up. I know Candy normally does it. She's been a little preoccupied with some other things. So I will be running that on Monday for new members. So if you can jump into that on Monday, I think I set it for a little bit later in the day. Maybe that makes it easier, maybe that makes it harder. I don't really know, but we'll do that on Monday. It will be recorded. If you're a new member, okay, please just take your time and go into the Discord, into the getting started, and just spend a week there and in the member videos and just observing what's going on. Don't make a trade for a week. Just take it all in, learn what's going on. If you want to ask a couple questions, fine, but don't ask questions until you've read the trade plan, until you've started to work on some things, until you understand things a little bit better, because I would say 95% of the questions that we get are already in the trade plan. And if you do have questions for Igor or I, just pop them in the main chat. We'll get to them. Sometimes members get to them before we do. They like to jump on questions, and some of them have really, really good answers anyway for you, which would be our typical answers. So a lot of our members know what we would say. If you send me a DM, I don't typically read those or look at that stuff on it. So ask the questions in chat if you want a response that way. If you only want Igor or I to respond, then you can go to the IN mod questions there, and it's just he and I will look at those. Okay, but please just make sure you've read through stuff before you ask questions.
One more thing I would
Yeah,
like
go
to
ahead.
add. We have, I don't know, this is um, you would think that when there are others there are not imitating but mimicking you or creating fake profiles that you've made it somewhere in life, but There are fake accounts that pose as myself and Tom and maybe even a few others, sending you direct messages, sending friend requests, and then trying to, it starts with a small talk, and then it goes into, hey, you want to do what I do, exactly how I do it, and they take advantage of our members having their guard down, thinking that they're communicating with either one of us directly. They offer them some sort of a scam, invest in Bitcoin or send me money and you will automatically copy our trades. We don't offer any of these services. That's not what we do. We're here to help you build your plan and help you get on the way in your trading journey and your trading business. So we're not sending you direct messages. uh, be aware. I mean, we post this all the time on Discord. Be aware if you're not sure, there's a channel, tech support. Just verify. Say, hey, I got a Diane from blah blah blah. Is this really you? Share a screenshot and we'll verify. You know, we do if we do speak to somebody privately, we'll let them know that hey, I sent you a DM. Please check. And but if you just get an unsolicited offer from either myself or Tom, 99.99999% of the time, it's not us. So, be aware.
Yep, great point. Good thing to put out there. We want you guys to stay safe. Unfortunately, there's people like that out there that are going to take advantage of you. So just be aware. That's why I typically don't look at my DM. So if you do DM me and I don't respond for a couple days, I get it. I know some of you have reached out for some coaching or mentoring and stuff. Okay, I will look at those. It's been a busy week. We'll get that all squared away. Um, but yeah, we're happy to have those of you that are new. We're happy to have all of you that have been with us for quite some time now, and we hope to continue to grow this. And if you're going to post stuff in there, just make sure it's got value to it. And the more value you add, okay, the greater this community gets. And it's really a community knowledge base that we're building here. There's a ton of knowledge. I mean, you could just not actually share any trades, and the knowledge base that we've built here is enough to probably make your membership worthwhile, even if we never traded and Igor and I just went away tomorrow. So there's enough stuff in the forums, okay, to keep you guys busy for probably the next year or two. So there's a lot of really good stuff there. Just add value. Okay. If you're going to type something before you hit send, okay, think, am I adding value to what we're doing? Okay. Before you post anything, am I adding value? And as long as you add value, man, this is great stuff. We'll continue to keep it open for everybody. So hope this was helpful there. I know maybe there's some other questions. We'll keep doing these. I know this week we did a good bunch of videos. It's my goal to keep trying to do at least 2 to 3 videos a week as opposed to just 1 or 2. So I'm going to try to up the sessions a bit more. I hope these are valuable to you, and we'll let you guys go. Enjoy a great rest of your day. Enjoy a great weekend. Looks like we're new all-time highs again in the portfolio. 2 more wins today with a ZB Strangle winner, get a 0 DTE Strangle in the active trader service as well. So adding some more winners on, and we'll see you guys on Monday.
Have a good
Have a great
weekend,
rest of your
everybody.
day.